Good morning. I'd like to open the Audit Committee meeting for the, really it's the month of April, but it is May. So I don't think there's been any changes to the audit work plan. Our next meeting is scheduled for July. And at that time we'll be spending time on the status of the 2012 audit plan.
Correct.
And other agenda items will be management letters and quarterly consolidated financial statements, etc. Right now, I'd like to call on Lamont Kirst to give us a financial interest update. Oh, I need a motion to approve the minutes. Okay, we can come back to it. We have no public comments, so we move to the approval of minutes of January 24th. I need a motion to accept. Moved. Can I get a second? All in favor? Aye. Opposed? Carried. Okay, as I said, our audit committee work plan is there's no meeting next month. There will be a meeting in July, and pretty much the work on the July will be the 2012 audit plan, the management letters, first quarter consolidated interim financial statements, investment compliance report, single audit, and review Inspector General's office. Okay, Lamont, financial interest reports.
Thank you. As you know, each year, certain MTA employees who are designated as policymakers or employees who make over a certain salary threshold are required to file a financial disclosure statement, as well as MTA board members. This report that you have in front of you is for the year 2011. We had 5,875 employees who were required to file last year. Of that number, only 54 did not file on time. That is a substantial decrease from last year when we had 141 who did not file. So the numbers are improving. Of that 54, as of now, we know of only 4 that have not completed their filing.
Any questions? I know we just got the current email for the financial.
We sent out a reminder memo to all our employees, and we also have sent out a memo to the board members as well, reminding them that it is due and that we are available to help you if you have any issues or problems with the filing.
It's May the 15th, I think.
May 15th, that is correct.
Aren't we extended to the city deadline? If you're filing city...
The city's before that.
The city's before that.
City deadlines have been extended if you haven't filed the tax return. You got an extension.
If you're going to ask for, if you're going to do an extension, you should let the commission know that you need an extension, and I can help you with that.
To my knowledge, it's never been automatic.
No, you need to let the commission know that you need an extension.
You need to apply for it.
Who administers the penalty for not filing this?
If a penalty is imposed, there's a notice that goes out. That notice goes to the chairman and to myself. Obviously, once we get notice, my office will reach out, usually with the assistance of the general counsel's office for the particular agency, to rectify the situation to make sure that the employees, in fact, pay.
And is it being enforced in that way?
Yes, I mean, we have had situations where employees haven't paid, and we try to do it nicely at first. We send out a nice little email and a notice, but if it continues, then we have a rather interesting face-to-face conversation about, their future at the MTA. I mean, we take it very seriously in terms of filing. I mean, if there's a penalty, it needs to be paid.
Which is $10,000?
Oh, no.
But
that's the penalty is a maximum of $40.
$40?
$40,000.
Oh.
No. The penalties don't start off that high. I mean, the penalties are relatively modest. I mean, they come in, first penalty is usually 100, then it goes to 2, then it goes to 3. So, it's an escalating penalty that gets applied, but it usually doesn't start anywhere nearly that high.
And you administer this?
I don't administer it. The commission administers the fine. What we do is indicated in this memo, through board direction, we are required to cooperate and assist the commission in fulfilling their obligation to collect that money, and that's what we do.
Thanks.
Any questions? Great. Okay, 2011 financial statement. David, you're on. Okay. Good. Okay, great.
Okay. I tried to boil down the consolidated financial statements to a presentation, which I'm hoping everybody got in the mail. So I'll walk through that now with you. Okay, the MTA consolidated financial statements basically are prepared in accordance with generally accepted accounting principles, GAAP, as applied to government units. And for government units, the accounting rules are issued by the Government Accounting Standards Board, otherwise known as GASB. The consolidated financial statements include 5 sections for the MTA. There's the management discussion analysis, the basic consolidated financial statements, which include the balance sheets, which are assets, liabilities, and net assets. We have the consolidated statement of revenues, expenses, and changes in net assets, and then the consolidated cash flows. Next, we have the notes to the financial statements, which have essential information to get a full understanding of the numbers in the financial statements. The next is the required supplementary information, which is required by GASB, and that's information on the MTA's funding progress for its pension plans and its post-employment benefit plans other than pensions. And then finally, we have additional supplementary information, which is a reconciliation of the audited consolidated statement of revenues and expenses and changes in net assets to the MTA Group financial plan actuals. Okay, starting with the balance sheet, basically we'll look at the assets. Assets increased 4% from 2010. Increased by $2.3 billion. The biggest part of our assets, of course, are our capital assets. Capital assets are 83% of the assets on the balance sheet. Capital assets increased by $1.7 billion, or 3%, and then other assets, which are about 17% of total assets, increased 6%, or $580 million. Taking a look at the breakdown of our net capital assets, we see we have land, construction, work in progress, buildings and structures, bridges and tunnels, passenger cars and locomotives, buses, infrastructure, and other. The largest increase for fiscal year 11 was in other, increased 20%, or $1.5 billion. And the largest increase there is attributable mainly to the Transit Authority, that had about $1.5 billion in station rehab work. The next largest increase was in infrastructure, $810 million. And again, that was the Transit Authority, the biggest piece of that. They had about $711 million in infrastructure improvements. Okay, next, this is a listing of some of the major capital projects that contributed to the increase in net assets for the year. So we have our mega projects: East Side Access, Second Avenue Subway, Number 7 Extension, station improvements for Jamaica, Penn, Moynihan, 7th Avenue line, Queens. The infrastructure work was done on the bridges, the Bronx Whitestone Bridge and the Throgs Neck Bridge. We had track rehab work, signal and communication projects, and rehab of line structures and subway tunnels. And finally, we had purchases of buses and new cars for the New Haven Metro North Railroad. Looking at the rest of the other assets, 10.7 billion, increased 6% from 2010. So we have cash, we have investments, current, non-current, we have receivables, current, non-current, and other assets, current, non-current. The biggest increase there was in other assets, which is a large part of that is the increase in derivative-related assets of $339 million due to period-to-period changes in the fair market value of derivatives as reported under GASB 53. Next, we'll take a look at the MTA's consolidated liabilities. Consolidated liabilities for the end of 2011 were $46.4 billion, an increase of 7% or $3.1 billion from the prior year. The biggest increase there was in post-employment benefits other than pensions. That increased $1.7 billion. And the reason for that increase is we had increased claim cost. We had the reflection of health care reform in the numbers this year. And we reduced the discount rate from 4.2 to 4%. Basically, the total expense was $2.1 billion. And of that, we fund on a pay-as-you-go basis. So we funded about $390 million. So the difference is the increase in the liability.
What do you base the discount rate on?
Well, it's based on the earnings of our plan assets.
Mark,
So that's not carried with assets in any case.
no, Mark, it's based on our assumed earnings over time, and we have funded the trust, and we have not fully, but we've made our first deposit into the trust itself for $125 million, and we have a plan to take the monies that we've been accumulating and deposit that. We have an RFP that's out for investment managers for all of our pensions that we manage, and also they would be responsible for this as well. So that's our judgment, talking with Milliman and also talking with Deloitte as to what we think is an appropriate
4%.
investment rate for those monies. And it seems to be in keeping with what other funded trusts are as well.
Bob?
Yep.
Yes,
Which is based on what current earnings?
4.2 to 4.
Right.
Chuck?
I'm looking at a figure of 1.705 for post-employment benefits other than pensions, a significant increase over last year. Why?
Well,
The formula to calculate it just changed with the investment rate which you chose to change.
Sorry?
well, there were three categories for the increase. First of all, just let me explain. The total expense was $2.1 billion, but we don't fund all of that expense. We only fund on a pay-as-you-go. So what we fund is we fund the actual cost to pay the premiums for health insurance for retirees. So that was about $390 million. So the difference is the increase in the liability. So basically, this is an unfunded liability, the $6.6 billion. But the reason for the increase were three things. It was an increase in our claim cost. A large piece of that was in the pharmacy area, pharmaceuticals. The second was the reflection of basically health care reform, Obamacare, because the actuarial report was done 2 years ago, so it didn't show the effects of health care reform. Now it does. So there are various aspects of health care reform which increase the cost of post-retirement benefits. And then the third piece was the lowering of the discount rate. So by lowering the discount rate from 4.2 to 4%, it increases the overall expense.
Any other questions, comments? Okay, continue, thanks.
Okay, there is a typo on here in the last bullet. It says other long-term liabilities increased by 346 due to an increase in derivative-related liabilities of 325 due to changes in fair market value of derivatives. That should be GASB 53 and not 35. And that's kind of the flip side of the increase in the assets. So the way we record the derivatives is it's all balance sheet. We defer any changes in the fair market value. So if an asset goes up, a liability goes up or down. Now we move to the revenues, expenses, and changes in net assets. Operating revenues were up 8%, and most of this has already been reviewed with the Finance Committee. That increase is largely attributable to the increase in the fares in December of 2010. Total operating expenses before depreciation were up 9%, and again, that's a large part of that is a $574 million increase in the post-employment benefit expense other than pension. So the items we just talked about, almost $600 million of that $981 million increase is attributable to other post-employment benefits. There were also increases in other labor increases in employee benefits and overtime. There were non-labor operating cost increases in fuel and propulsion power of $77 million and increased maintenance and other operating expenses of $46 million. Total net non-operating revenues increased by $283 million or 7%, attributable to increased grants, appropriations, tax revenues. And also that was offset by $130 million increase in interest expense. So that's a net number. Interest expense is netted against those revenues. So total net assets changed by $860 million, decreased by $860 million for the year. So ending with total net assets of $16,016 million for the year. Next, we'll take a look at the net assets on our balance sheet. We have to show our net assets under GASB 34. Net assets have to be shown as net assets invested in capital assets, net of related debt, any restricted net assets, and then unrestricted net assets. So invested capital and assets net of debt, $20.2 billion is basically our net capital assets, reduced by the debt related to building or acquiring those assets. Assets restricted for debt service are restricted by debt covenants, and restricted for claims is basically the net assets of the fintech company, the captive insurance company. The unrestricted accumulated deficit of $5.5 billion, of course, that includes unfunded liabilities like OPEB of $6.6 billion. So if you take that out, our unrestricted assets, it would be a positive number, but this is accrual-based accounting, so that's why you have such a large accumulated deficit there. Next, we have the statement of cash flows, which basically summarizes all of the MTA's cash flows into four categories. Net cash either used or provided by operations, by non-capital financing activities, by capital and related financing activities, and by investing activities. So for fiscal year 2011, our cash used by operations was $2.7 billion, which is $375 million better than the previous year. Cash provided by non-capital financing activities, that would be grants, appropriations, and tax revenues, was $5.1 billion, which is $549 million less than the prior year. Net cash used by capital and related financing, That would be purchases of capital assets. That would be our debt financing, lease payments. That was a use of $2.6 billion in cash, and then we had positive cash of $171 million from investing activities, resulting in a net increase in cash for $3 million for the year. So we pretty much ended the year on positive cash flow, $203 million. In our required supplementary information, we have the progress on funding our pension plans. So this is a summary of the three plans, the three single employer plans. The total actuarial value of plan assets for the year ended were about $2 billion, an increase of $103 million from the prior year. The total actuarial accrued liability was $3.4 billion, an increase of $67 million. And the total unfunded liability was $1.8 billion, and actually decreased from the prior year. So we had a slight improvement there. The combined funded ratio for the three plans is 53% versus 51% in the prior year. The other required supplementary information is the post-employment benefits other than pensions. The total accrued liability, actuarial accrued liability, is $17.7 billion. So that was a 35% increase from the prior year. And we went over the three reasons why that went up so much. Now, of that $17.7 billion, we do have recorded on our balance sheet a liability of $6.6 billion. So roughly $11 billion is not recorded in our financial statements. Well, we opted to amortize that liability over 22 years. So we have the choice of either recording the full liability or amortizing it. So a choice was made to amortize it over 22 years. So we're now in the 18th year of amortizing that liability.
So you have 2 more years to go?
18 more years to go.
18.
18, yeah. So. And finally, we provide a reconciliation between the audited GAAP financial statements, the statement of revenues and expenses against the financial plan actual for fiscal year 11. So we reconcile that. That's an additional disclosure that we provide for the audit committee.
Doesn't matter. Oh, can you go backward just 1 sec? You have 18 more years to go. What, David? I don't know if you can help or who answers this. So that means, just to help me out, 18 years ago you made certain assumptions as to.
No, about 4 years ago.
4 years ago you made certain assumptions for 22 years. So we're 4 years into it.
What happened?
Do we revisit the assumptions made, or is it?
The issue was really it was when the accounting pronouncement was implemented. You had there were certain things that you could have done, and by the way, most elected to apply the accounting pronouncement prospectively. So what they did was that 22 years represented the average age of the working employee. So the decision was made to amortize it over that. Actually, they do look at that every year to see if that average age is where they are in the amortization is appropriate. And so far, it's holding up. So it really wasn't a choice per se. There was a choice about whether or not to do it all or to apply it prospectively, and they chose, as the vast majority of governments did, to apply the standard prospectively.
Isn't that essentially just kicking the can down the road?
Well, actually, this is something we've talked about. As you see up on the screen, the unfunded liability is $17.7 billion. Again, the expenses that you've been hearing about, most of them are unfunded. So they're just bookkeeping entries that we are required to make. The amount of money that we've been funding is just the current cost, and as Pat said earlier, is about $390 million, $400 million. So we do that. We have been purposely setting monies aside to try to reduce the unfunded liability, and that's the amount that we often talk about the GASB fund that you hear. We have about $480 million that we accumulated for that, and as I said, that right now is sitting in our bank account. It's our general liquidity fund. We're starting to move that into the trust, which has been established, and so we just moved $125 million into the trust, and we have a schedule that over this year we will be putting most of that back in. But this is something that we really think is important. I believe that $17.7 billion unfunded liability is a significant real liability. I believe it's just like our pension obligation to our retirees. So it's a huge number, but we are trying to start to set monies aside. The ideal world is when we have the money into a professionally managed account, we will receive a higher investment return, which will bring that down. Right now, the money has been pretty much, as I said, in the liquidity account where the return has been very small. But the goal is, again, to have this under professional management, where just like our pension assets will receive a higher return. So, again, it's a large number. The expenses we're talking about are large expenses. What we're actually funding is much smaller, but we have made a commitment to start putting that money aside into a trust to address the obligation to our current and future retirees.
If you put aside or deposit in the trust money at approximately the same rate as you're doing now, will you at some point within that remaining 18 years be able to reduce that number or eliminate it significantly?
We will be able to reduce that number. We're not going to eliminate it with the amount of money we're putting aside right now unless we get some significant returns. But again, anything we can do to reduce that will just reduce what we do have to eventually pay. And so that's the goal. I think I've expressed to the board and to the finance committee and to the board that what I think we ought to do if we ever are the beneficiaries of some of the windfalls that we've seen in the past, such as when the real estate revenues came in significantly higher than what we had budgeted, that's the time to take those monies and fund this OPEB obligation. For those members of the board who've been here for years, we did take some of the money, real estate windfall, if you will, and use that for pension funding. And we took some of it and set it aside for this OPEB, and that's really where we got kind of a kickstart on some of the monies that we do have now. But to me, Chuck, that's one of the things that we do need to do is if we're ever going to be the beneficiary of a windfall, to use it for these one-time deposits, which will eventually give us a recurring benefit.
Until a few years ago, the normal accepted practice for retiree health benefits were that they were paid by at least public employers as a current cost. And that is in fact what we're doing. The actuarial valuation of retiree health benefits is a comparatively recent amendment to the accounting principles that go into the way our operation is presented. When you think about how to calculate that number and what assumptions go into it, you can say that it's a retiree benefit, therefore it's just like a pension, except that there are many guesses that go into pension actuarial funding, but at least you have at least some basis of presuming that when somebody retires, he will retire with the pension benefit he is entitled to, and that's the number that you will be funding for what you predict to be his lifetime. On the health side, one of the problems is you have no idea what the health benefit is actually going to cost and what escalation factor to put into it between now and when the person retires, not to mention between when he retires and when he drops dead. That's one of many extraordinary leaps of imagination that go into creating this mammoth number. I would say that, if we were Eastern Airlines and likely to go bust sooner or later, so that our employees are going to be high and dry in terms of this retirement benefit, there would be a compelling reason to spread the source of funding more broadly than our own ongoing business. I don't believe that we're going to go out of business as a practical matter. I also think that this question of ultimately, are health benefits going to be paid forever by employers, or is some other scheme going to evolve? I mean, if you looked at the world 40 years ago, you would never have expected Medicare, which has actually made a significant difference in this picture. Although we are required to put it into our financial statement as a liability, we are not, in fact, required to fund it. Well, again, this formulation creates a mammoth number. If you actually had cash in it, among other things, because of the rate of return, which I don't know what rate we're using on our pension funding at the moment, 7.5. If you use 7.5 instead of the 4 that we have conservatively moved to from our 4.2, that number would be significantly different in itself. And if we actually had it cash funded, that is the number you'd be using. All I'm saying is that this is an extraordinary sort of souffle of dubious substance coming up with a mammoth number that we are obliged to publish about ourselves.
I really thank you. As always, you are not only instructive but informative and helpful.
Any other questions?
But Mark, that also makes the year-to-year comparison even more, to put it in at least a context and to determine what changes are made in the assumptions and when and why, right?
Yeah, I mean, there's a lot of this stuff that if you actually think about what it means to us, I mean, there's a long tirade that one could go into. I mean, that question about the, I'll try not to make it long, that question about our net assets, what we had was a catalog of the money we've spent on our capital program in the last year. And yeah, I mean, we built some stuff, and you can value it if you want to, and that's fine. But quite honestly, as an asset, you think we're going to sell those cars or that track or the rebuilt station and turn it into money to demonstrate that, we have as many assets as we have liabilities? Thank God. I mean, it doesn't make any difference, quite honestly. It's like selling Central Park. You can't do it. So in terms of the useful information that comes out of this picture, obviously there's a great deal, but there are some underlying structural assumptions which give you bottom line answers that you think should be highly significant, but when you go back through the pieces and begin thinking about what they mean, it's not so straightforward. Sorry.
Can I just ask one question about the unfunded liability amortization of that? That means that each year you move it from this supplementary information to the balance sheet, a portion of it. But it doesn't have anything to do with actually funding it.
That's correct.
It's expense only is what Mark said.
And the expense goes through the income statement.
We fund on a pay-as-you-go basis, which means we pay current benefits currently. The expense includes, among other things, all of those assumptions that Mark is talking about for the future, and we amortize the total cost of an employee, the assumed total cost of an employee over their working life versus when it's paid out. And what's going to happen is the employee's going to retire and is going to live, and that's another assumption that's, that's volatile at times. It's going to live for another number of X years. We will have recognized, or you will have recognized, the expense theoretically when that person retires versus when you pay the benefit.
I don't mean to protract this, but let me just ask you this question. An unnamed adjacent state, according to the Pew report, has significant, if not overwhelming, unfunded liabilities, both on the health care side and on the pension side, which are hobbling its credibility and its finance. In your view and your best assessment, we are not anywhere near there, are we?
I do know the state that you're talking about, and it's a different circumstance. You're probably at the same place as they are relative to funding post-employment benefits, but you're at the same place as the vast majority of the country, because most funded on a pay-as-you-go basis. Very few have funded post-retirement benefit plans. Because, like Mark, if you assume you're continuing on a going concern, your payments, your annual payments are your annual payments and nothing more than that.
Let me restate it in another term. I drink coffee, not tea, which is a analogy that you can ponder upon. Am I in trouble? Is the question.
I'm not quite sure how to answer that question. Let me just back up and say, as you know, the way we do our budgets, we're required to have a budget that's self-sustaining, and we're required to operate on a self-sustaining basis. So when we go through and present a budget, we have these non-cash items in it. We have depreciation in it. We have OPEBs, the full OPEB expenses. But then we come down and back out the non-cash items to come down to a cash basis. And we're allowed by statute to use prior funds, operating funds, to roll over to offset the next year's deficit. And so again, we really operate on a cash flow basis. Our bondholders look at us from a cash flow basis to see, do we have enough money to pay our operating expenses and to pay our debt service and to meet those obligations. The rating agencies are starting to look not just at your debt service, but they look at how you're funding your pension, and increasingly they're starting to look at, are you trying to address the OPEB? Nobody's expecting us to fully fund our OPEBs the same way that we're doing our pensions right now. Will we ever have to move that way? We'll move as the whole industry, the whole municipal market starts to move, and we'll be consistent there. But I think for us not to be aware of what these obligations are and not be making some attempt to reduce the future cost would be a mistake. When you look to see the line items in our budget that are growing greater than inflation, clearly pensions are growing greater than inflation, OPEB's healthcare cost, whether it's for current employees or for retirees, is growing much greater. Our debt service is growing greater. We have costs that are growing greater than inflation or some of our other controllable costs. So we are trying to demonstrate that, in fact, where we can, we're reducing those costs, or we're trying to set aside monies to meet increased costs in the future. So I feel like we have a good handle on what we're doing. We're not in trouble. We're being astute managers, and we're being financially prudent in how we're addressing current and ongoing obligations.
That's the statement I wanted for the record.
Bob, anything from the rating agencies in their most recent reports or comments, informal or updating, with respect to these issues that you could highlight for us? And I appreciate very much your last comment. It was very helpful.
Yeah. Again, the rating agencies in their comments focus on a number of things, how we balance our budget. And I think that they have recognized that we always project out-year deficits, but they're pretty consistent in saying we always balance those budgets as we approach them. And I would say it's similar to how the city, if you look at the city's finances or the state's, there's out-year deficits that are often projected, but it's the consistency with which you're able to address them in a reasonable way without having to rely upon one-shot actions that give them comfort that you're well managed. And I think we have a pretty good, track record there, and I think it's reflected in the rating reports.
Including the OPEB and the...
Yes.
Thank you.
One of the things that I look at, we look at those financial statements. I think we got 113 pages, which is pretty hard for the average Joe Blow to go through. But the thing that I always look at, first thing, are the last 3 pages, which were with a comparison to the financial plan and how it was presented to us as we went in done business over the year, to see how close that was to our audited plan, because that always gave me assurance that what we were being told by our people every month, okay, was really close to what came out. And if you look at that, the changes in that, very, very minimal, okay? And most of them, and all of them, really have to do with cash and non-cash items.
Right, that's right.
If you'll remember, Jim, the reason that schedule's in there, because that was, remember the state requesting certain changes to be made to the budgetary practices that you and we concurred was probably, not in the best interest of. So the agreement was to basically always reconcile the financial plan to the audited financial statements, and that's why that's in there. And those differences should be minimal,
Yeah,
right?
yeah. And I look at it because every month we come to a meeting, and we go to the finance committee, we go to all the different various agency committees, and they give us a financial update. Well, there's nowhere that we can find out, except here, how close they were to actual. And that's why I look at that last page, and to my knowledge, ever since we've been doing this, there's never been a tremendous difference, which tells us that our accounting people are doing a great job, okay? Because when they come that close to an audited financial statement, that's a good sign. Any other questions? Okay. Dave?
Good. We are in the process of completing the audit for the consolidated financial statements of the MTA, which includes, by the way, I'm talking individually and collectively about the MTA and all of its components, which would be the First Mutual Transportation or Transportation Assurance, Long Island Railroad, Metro North, Metropolitan Suburban Bus Authority, the MTA Bus Company, New York City Transit, and CERTOA. As your auditors, we are required to perform a review of internal control under general accepted auditing standards for the purposes of not giving an opinion on the system of internal accounting control, but for the purposes of obtaining an understanding such that we could design appropriate audit procedures and audit tests to assist us in issuing a report on the financial statements. As your auditors, we're also required to look for items that would be material, what we would call a material weakness in the system of internal accounting control, and to the extent that we find one, we're required to report it to you. We do have one this year, and it relates to CERTOA. There were some changes in management that occurred there, and as a result of the changes in management, they really didn't have the staff or the expertise to put together financial statements in a timely manner, and as a result, we weren't able to complete an audit of CERTOA. Now, however, CERTOA is very immaterial to the financial statements of the MTA on a consolidated basis, so it has no impact on the financial statements. Those numbers are included in the financial statements, however, they haven't been subjected to audit.
When do you have a timeline when you think you might be able to?
We think it's a week to 2 weeks. That's what we're being told.
And also just to
Please. Can I get a statement for the record, please? Am I correct that management has been fully cooperative in providing you all of the information you require?
I'm going to get to that, but the answer is yes.
Am I correct?
The exception of the CERTOA, we would say, because of just termination.
Am I correct that there has been no incidents of which you are aware, in which any information has been withheld from you, denied to you, or not provided?
If there was, I would have informed you and would have
All right.
dropped.
So that is not a reason for the delay, am I correct?
No.
That's all I want to have for the record.
Yeah, and let me also just interject here. CERTOA's operating budget is about $41 million. So $41 million out of the $12.6 billion budget for the MTA. That's why we say it's immaterial. The numbers have been reflected in the consolidated statement. The fact that the audit wasn't performed on those isn't the issue. And I would say that, we have put in place now, or put it in place, a new mechanism. CERTOA's financial functions are really going to be subsumed in, or assumed, I should say, by Transit's operations, and so that will be done now going forward. So I don't expect to have an issue here.
Also, while this may be immaterial, it really poses a bigger question in my mind, which I think is agency-wide, and that is that we have no succession planning, okay, within any of the agencies. We try succession planning, but it never comes to reality.
And one of the things, we will have a management letter that we'll talk about this in the next meeting. And some of those items we will address. One of the things is that, it's not a problem per se, but one of the things we may very well talk about is some suggestions for to address that issue.
CERTOA may be immaterial from the perspective of the overall financial statements of the MTA. However, from the perspective of CERTOA, which is actually a reasonably significant operating agency for the service we provide, the fact that they don't have financial statements, and it's now the beginning of May following the year ended, is a major problem. It's really extraordinary, I hope.
Just to follow that up, I think the other thing that I've been thinking since discussing this with Mike is, the accounting area may be an area that we look at to consolidate going forward. It seems to be that, debits and credits, it's
worthy of discussion.
Right. That's exactly my point.
It is something that we have discussed, and I think the thought is let's get release 2 for BSC done. Let's make sure we have that, the bugs worked out there, and then we will look to consolidating accounting functions where it makes sense. But again, it should be something that we pursue because it's just a continuation of the BSC type approach.
I guess consolidating accounting functions may be the way to go, but quite honestly, our problem here is that there isn't somebody who, at least I would infer that our problem is there isn't somebody who is actually familiar with the operating numbers of CERTOA who can translate them into accounts. And the problem with centralizing an accounting function is, as has been observed earlier, this problem is immaterial in terms of the overall scheme of things. And you need to hold on to actually having an engaged brain in the day-to-day management of this portion of the MTA who's following what's going on and is able to translate that in terms of accounts. And I would worry that by centralizing the function, you lose that.
Mark, you're always going to have somebody at each agency who is watching the accounts and managing. So we're not talking about doing away with it completely, and there would still be someone in the transit organization responsible for the accounts of CERTOA. We have to record the accounts of CERTOA. We have to track the expenses because, again, we're receiving a subsidy for that, and we have to be accountable to make sure that the subsidy that we're receiving is justified. So we're not losing the accountability. We're just simply saying we want to have people who, are properly trained, understand the PeopleSoft, understand the consolidation process. And again, we just had turnover there in the third quarter, and we lost some personnel. So I think people were aware that there was a problem. Resources have been mobilized to get them together, but it's just, it's something that I don't expect to see replicated again.
Processes they So we do a good bit of work. There's also the market value of investments. There are certain, investments that require some assumptions relative to the valuation methods. We look at those, challenge those, and actually do our own independent of managements to determine if it's appropriate. The allowance for doubtful accounts is a judgment that basically is based upon management's knowledge of those particular issues. We question management about those issues, and we actually do a look back of the allowance to see how currently it is performing compared to historical experience. Depreciation is your policy. We do look at your policy, do recalculate it, do challenge management's view of whether or not items will continue to have a useful life, our remaining useful life that exists in the financials. We look at your accrual processes. I mean, there's a number of accruals that appear within the financial statements that aren't just normal accounts payable, but there's other liabilities that require a bit of judgment and assessment, such as estimated liabilities for injuries, contingent liabilities. So we look at the process that management uses to make those judgments, estimate those liabilities. We challenge those, and also we do a historical look back to make sure that that there's nothing that's in the current year that's out of line with past experiences. We look at obsolescent reserves and inventories. We look at the environmental accruals contingency. That's not as big of an issue as it used to be. And then we look at the derivative financial instruments and how those items are priced, and whether or not the assumptions used in estimating the market value is appropriate. And then we look at the hedging activity. There are a number of financial instruments that are for accounting purposes designated as hedges. We look at those items to determine if the methods that the MTA is using is appropriate for determining the effectiveness of the hedge. We challenge that, have discussions with, they use a third party to assist with that. We have discussions with them, and we monitor that fairly carefully. We're required to disclose to you any uncorrected misstatements that we noted during the performance of our audit. There were none to report to you. There are no material misstatements that were brought to our attention as a result of the audit. The significant accounting policies that appear within the financial statements, and they appear generally in Note 2 in all of the financial statements that you've seen. As your external auditor, we're required to evaluate whether the accounting policies are in accordance with generally accepted accounting principles, whether they have been consistently applied from year to year, and if the use of the accounting is appropriate for the organization. We have reviewed those and have determined that they are both in accordance with generally accepted accounting principles, that they have been consistently applied, and that their use is appropriate. The MTA during the year, was required to implement GASB statement number 54, which dealt with fund balance reporting, and their evaluation was that it didn't have a material impact on the financial statements. It didn't apply, and we have reviewed that and have concluded that that is correct. There was a GASB 59, and it relates to the reporting of investments in external pools. We looked at that and have determined that there was no impact on the financial statements of the MTA as a result of that. We had no disagreements with management. Management has informed us that there were no consultations with other accountants. There were no significant issues discussed with us prior to the our retention as the auditors, we encountered no significant difficulties other than the item that we previously mentioned in performing our audit. Management, as you are aware, is required to make certain written representation to us as in connection with the audit. Those drafts of those written communications are included in the as an appendix to our letter. I'd be glad to answer any questions that you may have.
Any questions? I think we answered all the questions. Okay, I need a motion to accept them as submitted. Second. All in favor? Opposed? Carried.
Thank you.
Thank you. Okay, I'd like to make a motion that we go into executive session. Moved, second. All in favor? Okay, Gary, we're in executive. We're going to go in.